All right. Well, it's been a minute. Life sometimes has a tendency of pulling us in different ways.
It
But I got
does.
my co-host, my man, the man, the myth, the legend, my favorite lender, Ed Diaz, in the house with me today.
What's
Ed, how are you
up?
doing, my friend?
Man, we're doing. When one of the sayings is when times get tough, you got to get three times tougher. That's
Yeah.
kind that's kind of my new mantra, man. I heard another saying that says, "Hey, if you're not confused, you're not paying attention." Which
Yeah.
there's so much going on, dude. This is the first time I've seen where prices continue to go up and so do rates at
Right.
the same time.
Yeah.
Like the planet Earth is all upside down, man. Huh?
So much so where you have the entertainer slash rapper out of South Bronx, Cardi B, posting tweets about how crazy the housing market is with respect to buying and renting. I hear
Well,
in
it
some
goes to show
markets,
you,
yeah,
everybody's talking about it, even Cardi B.
yeah,
Grr,
yeah.
okay, oh, grr.
It was so funny. I see Daryl Fairweather, former chief economist at Redfin. I've listened to her on a few different podcasts. This lady, she
Yeah.
knows her stuff. She got the three letters, the PhD at the end of the name too in housing economics. So shout outs to her. And she even replied back, and she's like, she basically gave a reason why, and it was literally the same exact reason that I made a reel on Friday. And real quick, Ed, I mentioned in this reel because I had a past client of mine who reached out to me about potentially selling their home. They've
Mhm,
owned this home for 5 years, and now it's a rental because they've
mhm.
moved up and bought a bigger home in Los Altos Hills. And he's thinking like, hey, how's the real estate market in Sunnyvale? I'm thinking about selling. Does it make sense? And he was asking me a few questions, and I basically gave him the rundown because he was, why are the rates and the prices increasing? And I told him, I said, listen, more than half of the country, the majority of Americans that are homeowners have mortgage rates with a two or three in front of it. Now, if that's the case, what's going to incentivize you to want to sell that property and take on a 6% mortgage in, let's say, today's environment? Now, on top of so that handles the inventory situation, right? But when you couple the higher rates and the lower stocks, you got a lot less buyers that are out there as well. So you kind of have the stagnant thing going on. And I got excited because just a few days ago, I made a reel about that. I'm like, that's exactly what I said. And I got pretty excited. What are your thoughts on that? What's your take?
Well, I share the whole thoughts of our man Logan Motoshami, and I think we are in an interest rate lockdown situation. Just like he had said, I didn't believe in it either. But
Mm-hmm.
if you really peel back this onion, think about that. Look, people who are at 2.5, 2.8, 3% rates, they have no incentive to go anywhere else than where they're going to get a 6% if they buy that house over there and sell their house
Yep.
at 2.8%. And so, what caused this? Well, we all know that the Fed did what's called QE, which is quantitative easing, and they bought up a bunch of mortgage backed securities, which in essence dropped the rate to artificially low amounts. This has not been seen before, folks. And I don't think personally I'm ever going to see it in my lifetime again, the twos and the threes. Will we see fours? I've been saying this. I think we will in the next 12 to 18 months. Now, on the 21st, we have the Fed going to most likely raise the federal funds rate 75 basis points. And I think they'll do it again in November, another 50 basis points. And hopefully that starts to put the brake on inflation, which then will
Yeah.
bring interest rates back down, and I think they will be to the fours. But yeah, we have this phenomenon called the interest rate lockdown, which is people are not moving because they don't want to sell because they have really great rates, and they know that when they sell, they got to go somewhere else, and that somewhere else means another mortgage, unless
Oh,
they're,
yeah.
of course, buying all cash. Now, if you have somebody who's got a two or a three as a rate, and they're selling here, for example, California, and they're going to buy Boise, Idaho, all cash, then that's a non-issue.
Yeah.
Then that's different. But for folks who sell and have to get financing again, no. Well, which then brings us back to those of you who are wondering, well, should I buy now or not? Well, here's the truth. Then I'm going to let you take the second half of it, the real estate side. I love the saying that says, marry the property, but date the rate. Here's the truth. During the time, let's just call it 12 months to keep this simple. In
Uh,
12 months, what are you doing to make passive income? I don't know. But what I can tell you is you have the ability now to negotiate with sellers because they're more willing to now. There's less traffic, meaning there's less amounts of of offers, now's the time where you could negotiate a price with the seller. And so you could get a property potentially lower than you did before, take the tax write off for the mortgage interest and the property taxes for the next 12 months, and then
Hmm.
refinance. Nobody said you have to die with that rate. Matter of fact, I've been telling folks that I know, because I'm getting you in the house today, within 12 to 18 months, you're going to refinance. So I
Right.
will pay for your appraisal as a token of two things. One, my appreciation for you being a recurring client, and two, as a I told you so.
Yeah. Check out those
And on the
five
property
one and
side,
7-1 arms, folks.
totally.
Right.
Yeah, absolutely. I'm doing one right now.
Yeah.
7-1 arms, great. Even the fives, that's exactly right. But what are you seeing out there as far as seller mentality out there, Nima? I mean, are sellers a little bit more realistic now? Are they more willing to negotiate? What's going on?
It's going towards that direction a little bit more, yeah.
Right?
And I mean, it's something that I've been talking about with on listing appointments, and even folks that reach out to me regarding like my market update videos that I do on YouTube, and saying, for example, why are the 30% price reductions in your market, Nima? And I just, take a step back and I tell, well, that's actually a healthy market. I mean, with this market that we've been in, during the pandemic, when homes were on the market for, let's say, 3, 4 days, right? And they're multiple hundreds of thousands of dollars above asking price. These price cuts, I think that are a lot of them are happening is because they look at comparables that are wrong for today's market. If you're looking at comparables from Q1, even towards the beginning of Q2, you're going to see a lot of homes with buyers that were locked in at that 2 or 3% interest rate that we spoke of. Let's go on the higher end and say 3%. Well, you're going to get a different pool of buyers at 6% than you would at 3% interest rate. So we got to be mindful because of that. If you're going to, let's say the best comparable down the street sold back in March at 1,400,000, and you're planning on putting your property on the market for, let's just say, 1,399,950. Well, most likely you're going to have to do a price reduction. So sellers are slowly starting to realize that. The market's hindsight, right? Folks are saying, hey, I want to wait until the bottom, when it bottoms out, or when it, oh, we're at the peak now. Nobody knows. I mean, you and I follow people a lot smarter who've been in the industry, those folks that have doctorates in this field, and they really don't even know. It's all about the forecasting. So I joke and say, what makes you think that do you know something that I don't? Where's your crystal ball? But in all honesty, like that's the situation that we're dealing with right now. You're seeing folks that, right now, as you had mentioned, you're getting a lot less competition. There was an offer that I wrote on a property in Dublin last year that had over 60 offers on it. Now, while we were waiting for the mics to warm up, we were talking about a client that I was able to get him a home. He was very bullish on getting a single family home. He would not budge on condos and townhomes. So much so, where earlier in the year we started looking in Mountain House, which is right outside of Tracy. Very rural community, no
Yeah.
shopping centers, nothing. Tracy is the big city for the folks in Mountain House, just to put it into perspective.
Yeah.
And he was looking in that area just because he was that focused on getting a single family home. Now, in today's market, with the competition pulling back significantly, we were able to find him a home with great schools in Dublin, by the way, for under $1 million. That home would have easily sold over 1.3 if it was in January or February of this year. So that's great, right? We were able to get that home ownership. And to your part, Ed, he's going to most likely be refinancing in the future. I told him, if this is your first home, are you planning on staying here for over 10 years? He's like, no, no, no. I would like to stay here for 5 years or less. That's my goal. And looking into the 5-1 and 7-1 arms, I believe he started going with the 7-1 arm was the best way for him to go, because as you had mentioned, and he can refinance. And I think a lot of people have some negativity with how things were back in the Great Recession, around adjustable rate mortgages, those ARM mortgages. And man, I mean, just how stringent underwriting is these days, better than me. My ARM loan, man, the underwriter wouldn't leave me alone. If anything, I thought it was too strict, but who am I? So, those things are just a thing from the past. So, in conclusion, just like what you said, I'm going to take that away from you, Ed. Marry the home, date the rate.
That's it, man. That's exactly right. And I read another statistic, and I thought this was very, very apropos for just where we are as a society and why maybe, we have a lot of market timers out there. The average age in the United States is 38 years old.
Mhm.
Okay. And statistics show that if you're younger than 55 years old, you've never seen these economic situations. You've never seen this level of inflation happen this quickly, rates go up this fast. And so you're not used to it. And what we're not used to, we're fearful of. And then what ends up happening is that now you have technology that gives you, you can Google a bunch of stuff, right? And now you have all these market timers. Well, here's what I know. In my 54 years on this planet, pretty much every market timer, whether it was in stocks or it was in real estate, have been spanked.
Yeah.
Nobody I know has been able to call the future because that's called being clairvoyant, right? And so market timers typically get spanked, and which is why I say, look, if you can, then do. Like he said, and we've said it, this is here goes the third time. Marry the property or marry the home and date the rate. Refinance later, but during that time, you're building equity because otherwise your landlord will, right? Somebody's going to build
Yeah.
equity, right?
Yeah. Yeah.
And take the tax write-offs because guess what? We're pumping millions of dollars into the IRS, which is going to audit you. So you might as well start getting a little bit more of your IRS money back, right? By
Yeah.
getting some deductions.
That's
So
that's a great
do
point.
that. I think it's important to get your finances in order. And like
Yeah.
I've said this a million times, a property is the only investment I know that you can get all these tax write-offs, get an upside, which is called equity. And by the way, we're not even talking about the capital gains exemption rule, which allows you to exempt $250,000 if you're single or 500,000 if you're married without paying a penny in taxes, by the way. And you can sleep in it.
Shelter,
Where
right?
else, Nima? There's
Yeah.
nothing else, man. Even your car, if you're sleeping in your car, you can't do that. You can't get tax write-offs for it. There's no equity
Yeah.
there.
You
If
can't write
anything,
off
it's a
property
liability, right?
taxes. Yeah, you can write off those property
So it
taxes.
always
Mm.
comes back to real estate, which is again why 84% of all the Forbes 400, meaning the 400 richest people in the world, have created the majority of their wealth through real estate. It's not a coincidence. I didn't make this stuff up. These are facts. And so now we just have to reassess and how is our money working and where is our money working? Because I believe your money should be working harder than you, right? We've
Yeah.
gone through a pandemic. Think about all the things that happened to the people who didn't have money and didn't have liquidity. I see it. By the way, I'm seeing more and more luxury cars, not brand new luxury cars, but fairly new, people living in them. Because remember we used to talk about how everybody's one or two paychecks away from disaster? Well,
Hmm.
guess what? The pandemic caused that. Go look at the footage of Texas and all the lines, hundreds and hundreds of cars, a lot of them really nice ones, going through food banks to get food.
Wow.
So this is a wake-up call that we gotta mind our money. The days of the party's never gonna end are over. Now you gotta pay the lady at some point. Free lunch is not so free, right?
You got to pay off those
We're
credit
just
cards, right? Yeah.
right.
You can't
Credit
just be
card, by the
racking up
way.
the credit card, you know.
And did you see? I mean, the latest statistic shows we're 15% plus increase in credit card debt. It's
Yeah.
starting because people are starting to live off of that, right? So again, folks, you got to look at what makes sense. Now, if you can, then do is one of my great mantras because that's the reality of it. Trying to time it, it's never a good idea. Okay? Just like hope is not a good strategy, neither is timing, because most people will not
Yeah.
they will not be able to predict it correctly. But if you can, then do take the write-offs, take the appreciation, and then refinance later. And again, there's tools like adjustable rate mortgages, also known as ARMs. Like Nima said, you can get a 5 or 7. The 7 I like because it gives us enough time where if change happens, we have enough time to mitigate that because it's fixed for the first 7 years. But those kind of things, right? Those are
Yeah.
tools that are there available. And you talk to your mortgage person or talk with me. I'm always good for 20,000 questions. Ask me because I'm never here to sell. I'm always here to educate and to guide, just like Nima is as well. We're professionals. This is what we do 24/7.
Yeah.
We're here to help guide you, but look at the numbers. The reality is that if you're watching this, most likely you haven't been through cycles. So don't be fearful. Be prepared by surrounding yourself with people who can help you get prepared because we're the experts.
Yeah. Yeah, absolutely. And I know you have a background in speaking of expertise, right? Like in lending and in stocks. And sometimes when I watch these YouTube videos, because my friends love, I mean, for me, if anyone thinks about real estate, and I think of Nima Moridi, I'm obviously really excited. So please, send me your questions. It's great for me because you had a question you wanted to ask me. Meaning, to me that means like I was like that hyper local expert for them, and that's a huge compliment because that's my
It
goal
is.
before anything, right? And I know you're the same way. And when I get these buddies of mine sending me videos on Instagram about, hey, check out this YouTube video, and it's always like housing market is crashing, and the guy's like this. And if you folks are tuning in the podcast, not seeing the video, it's like his hands are at like the Home Alone, Macaulay Culkin,
Right.
hands at the cheek, screaming, and there's a big old foreclosure and a dumpster fire and stuff like that, just to make you, more clickbait essentially. And then, when you hear these guys, you look at their background. I'm like, this guy, follows stocks a lot. Interesting. And the reason why I'm bringing this up to you, Ed, is because I feel like a lot of people that follow stocks make the mistake of thinking of housing like stocks. And they're both investments, but they're completely different. Listen,
Completely different asset classes as well.
right. Yeah. Like you have a certain stock, let's just say it's dropped 10%, seeking alpha, or your financial broker says, sell it, just sell and liquidate. You're like, all right, man, it's going to go down even more. I'm just going to sell this and take that loss, whatever. Right. Nobody does that with their homes.
And
Oh, right.
and the home is not that liquid. You can't just call your broker and sell it right now.
Right there. Right. So what do you do? I mean, like to these, these trolls, these trolls, like I always say, be the detective, not the troll. Let's just say it's March, right? And from March to now, let's say your property values, although they are up year over year, from the peak in March to now, most likely they have dropped a little bit. They have come back to reality a little bit more, from a white hot seller's market to a normal seller's market. Now you've lost, let's just say 8 to 10% of your value from March to now. So does that mean that you're going to sell your home and liquid, find an agent, sell your home, sell your only form of shelter, and then just figure it out? Like you said, we're gonna go. Me and my family, we're gonna go live in the car, and then we'll figure out. But because rents are up over 20% too. But we're just gonna figure that out. Nobody's gonna do that, especially in an area that has the highest amount of equity in the country, where we live now. And I feel like I want to make a recording of this so I can just send it to someone the next time they send me something like one of those clickbait videos, because I love that they thought about me, but I'm like, realistically, that's all you're dealing with. It's just clickbait. And I wanted to get your take on that.
Well, a couple of things. Number one is you got to ask yourself, why did you buy this property? Did you buy it so that the second it went down, you're just going to bail? Or did
Right.
you buy it because it's shelter, tax write offs? Because even, let's stop there for a second. If you put in the tax write off as a benefit and then the small drop that we're claiming that we had, you're still up. You're still up. You've
Mm-hmm.
taken the monstrous tax write-offs. Remember, up to 750,000 in mortgage interest and $10,000 a year in property taxes, which covers most people. Okay. And then the other part is, well, it's shelter. Where are you going to live? What's your alternative here? And then the third and final, which is what I call my Mike Tyson knockout punch, is, you ready? I mean, here it comes. It's unrealized. We used to say this in stocks. Unless you sell, you don't have a loss. It's unrealized. Yes, it might be in the headlines, but it's not a reality until you sell it. When you sell, then the number becomes a real number that where you lost. So guess what I'm saying to you is write it out. So let's say it takes 12 months to write it out. Hello, that's nothing in the continuum of time here, right?
Yeah.
12 months to then get back on track on something that's already made you a ton of money. Look how much money you've made since the moment you bought it.
Yeah.
Let's
That's
use
very true.
that number. Forget about the year over year because those numbers they come and go. It doesn't matter, right? It's like the price of gas. Who cares what it was, 20 years ago? We're talking about now. And where was it pre-pandemic, right? And where do we think it's gonna go, right? Things change. If there's anything we gotta take away from the last 3 years, is that remember when people used to say change is inevitable? Now it's change is constant. This too shall pass. The reality is properties historically in California have never lost money. Depends on your period of holding,
Yeah.
right?
Not
Just like
everything can
really great
appreciate
stocks.
year over year, right? Every
Yeah,
single
you,
year.
you
Okay.
talk to Warren Buffett, he'll tell you What's what's your time horizon? If you're going to keep a stock for long term, you're not going to lose money. Not in blue chips. I'll never forget when it was announced that Steve Jobs was dying of cancer. Go look at the stock that day. That announcement totally tanked. You know why, Nima? Because everybody said Apple will not survive without
Yeah.
Jobs. This guy was one of the smartest people walking the earth. You think that he didn't have a contingency plan and had management people and he didn't hire talent? This is how he ran such a successful company, is because he had great people around him. Steve Jobs wasn't the janitor, the CTO, and everything. He didn't occupy every role. He had strategic people in all those positions that would survive him, which in fact, Apple became a $1 trillion company after Jobs, not before Steve Jobs. Take note,
Yeah.
okay? So the same thing applies to you. What's your contingency plan? Why did you buy this property? When you bought it, what was your time horizon? So let's just say you said, I'm going to live in it for 10 years and we're in year 7. Why are you talking about losses in year 7 when you said you were going to hold it for 10? Makes no sense, right?
Yeah. Right.
Let's get back to common sense. Although I know common sense is not always common, but let's bring common sense back
Yeah.
and let's talk about why you bought these properties or this property and for how long were you going to keep it when you bought it, not right now. Don't get caught up in the emotion because that's what news is about. When was the last time you heard millions of people caring about the firefighter saving the cat from the tree? That stuff doesn't sell. It's great, of course. I love it. But what do they really report on? How the cat died. Unfortunately, bad news sells more than good news. That's
Yeah.
why you don't see a lot of good news, folks.
Like headlines, we've talked about this before. They tend to terrify more than clarify, right? They
Yeah,
want you
man,
to
they
click.
polarize everything. It's like,
Everything
come
is
on,
falling, the sky. Yeah, but at the end of the
big
day,
and little.
Logan talks about it all the time, just the health of the American balance sheets and just how much money people have in their homes.
And how
Last year,
resilient we have been
yep,
as a US society. Think about all the stuff we've been through, the world wars, the Spanish plague, all the things that we've been through, and we still are the greatest country in the world.
mm-hmm, yeah,
And California being what? We're number 8, the eighth largest economy of the world. We were number 5 at one point. Okay, so we slipped 3, big deal. But we're still one of the largest, just the state of California alone,
yeah,
one of the largest economies of the world.
yeah.
We are the hub of innovation, folks. That's
I
not
still
going
saw it as
away.
we are still the most economically sound state in the
Yeah,
whole union.
totally.
We're definitely the powerhouse of the country.
And we innovate, man. I
Overall.
mean, look, if you're on a cell phone watching this, you could thank California.
Yeah,
Okay.
yeah.
You have an iPhone, you could thank California, right?
Yeah. And so 2020, 2021, right? Refi Central, new purchase applications through the roof, refis through the roof.
Free money.
2022, Edgar Diaz, what are you saying on the home equity line of credit front?
I think home equity lines of credit are great for short-term money. You're paying interest only anyway, which is what you should be paying. And then
Hmm.
when rates come back down to 4s, refinance it all, put it all into one. But for
Yeah.
now, take the cheap money, make sure you cash flow. Okay,
Hmm.
because financial planning 101, you should have 6 months of all your expenses socked away in an emergency fund.
Yeah. Now
So
let's
right
just say
now,
someone's pinched on money. I'm so sorry to interrupt you. Let's say
yeah,
someone's
no,
pinched on money and they want to pull out this home equity line of credit as lenders call HELOC. What would the percentage be? Let's just say, is it the same as a 30-year fix or an arm? Like just so people can get a rough
it's
estimate.
you're going to pay prime plus what they call a margin, and prime right now, what's prime at? It's at 5.5%, something like that, and you're going to pay a 2.5% margin, so you're going to pay
Mm,
sixes or sevens. But remember, you're only paying interest only versus a principal and interest mortgage payment. So your
that's true.
payment is going to
Yeah.
be lower, and that's why I say liquidity right now is important. Cash flow is
Yeah.
important because this too shall pass. But in the meantime, make sure you cash flow and you're liquid in case something
Yeah.
happens, right? So you make very minimum payments, and later on, you're going to catch up and restructure everything. Because believe me, when rates go back down to the 4s, you're going to refinance that stuff anyway, right?
Right. So you can refinance even though you get a home equity line of credit in 2022, and let's just say you got your loan in 2020, you can still get a HELOC in 2022 and refinance that, right? Just that.
Yeah, you can either do one or two things. You can either refinance the HELOC into your first mortgage. So let's say you just bought a house, I don't know, and it's in the sixes, right? Your
Mhm.
mortgage. Well, I already know you're going to refinance that when it hits fours. But let's say you also piggybacked it with getting an equity line of credit that you needed to do stuff to the house. Well, you're still going to be in the sixes or sevens, right? But you're paying interest only on that equity line of credit. When the rates hit fours, refinance the whole thing into
Yeah.
one lump. So
Mm,
that's one option. The second
yeah.
is you have one of those rates that we talked about that is causing the interest rate lockdown. You're in the twos or threes, which you should never refinance. Okay.
Hmm. Hmm.
When the rates come back down to the fours, just refinance that equity line of credit. That's it
Uh,
as a standalone,
yeah.
right?
Now
Shop it
let
around with credit unions because those are the best, by the way.
credit
Got
unions.
the
Yeah.
best.
Okay.
Credit unions, unlike the big banks like the Chases, the Wells, and the B of A's, the
Mhm.
credit unions, one of the metrics that is used to judge their success in financial health is the number of equity lines that they do.
Ah,
So
interesting.
guess what they do? A lot of times they give them away, especially if you open an account with them. Open up $100 account, $1,000 account, get an equity line of credit,
Yeah.
later on refinance it, everybody wins.
Sometimes you hear about folks, saying like, "Oh yeah, credit unions are great, but you got to be with, that credit union, and generally they can be sometimes very selective in this whole process
No,
based
there's
on your."
some that don't require anything like Golden One, for example, credit union,
Mhm. Mhm.
Redwood credit union. There's credit unions out there. Just again, go to Google. This is where Google is actually good, right? Go to Google. But I'm telling you, things like Golden One Credit Union and Redwood Credit Union are fantastic. You don't have to
Yeah.
be a member of anything to be a member of
Yeah.
their credit union.
It's probably a lot better option, right? We hear about people carrying on credit card debt. If you're a homeowner and you're carrying credit card debt, seems like it's a lot better option to get a home equity line of credit with respect to how much you're paying in interest, right? Opposed
Of
to just
course,
running
because
your
if you're
credit
paying
cards.
7% on an equity, let's just say you're paying 6.5 to 7% on an equity line, but you're paying 21% on that credit card, it's kind of a no-brainer, guys. The delta is huge, right?
Yeah, right. Very
Talking
much. Yeah,
15%, 14% delta.
yeah.
It's a lot of money.
Because we're talking about people getting priced out, right? I mean, the party's going, and if people got caught, certain situation, medical expenses and things like that. If you think, knowing a really good lender that can help you out with cashing some money out of all that crazy equity that we've all made over the span of the past few years can
Well, and
really,
a great lender will give you advice, right? Macro
yeah,
advice based on your macro situation. They'll ask good questions like, tell me what your goal is and what you're looking to do. And then
right.
when they pull your
Mhm.
credit and they look at all your finances, they'll say, hey, by the way, I noticed that your payment is very high on this one credit card. What's your rate on that? 21%? Well, you might want to do this then. Then they give you options that are based on getting you to a better financial position, right?
Right. Yes, that is good. That's good to know.
Yeah, don't go with somebody who's a transactionalist. All they care about is just what you told them. You told them I need to refinance. Oh, okay. No, not that one. It's the one who says, "Oh, okay, tell me why. What's your motivation behind?" And if it's okay, once I look at all your information, if it's okay, can I give you some recommendations and some advice? That's the one,
Yeah. Yeah.
because those are real practitioners. They're not transactionalists, right?
Yeah.
Big difference.
Absolutely.
Big difference.
It's providing that value and educating you and guiding you in the right direction instead of,
Advice matters.
you know,
Absolutely. Think about
when
all the new nuances that
Mhm.
you advise on buying a house.
Yeah, I was literally just about to get to. I love how you and I like our wavelengths are like in sync here. Like I was actually going to ask you earlier about a lending, about like, some of the lending practices, and you went into it. And then just right now, when you're mentioning about people that reach out to me about homes, I literally thought the same exact thing when you were describing that because you said why. When people ask me how the market is, I say, well, it depends. Are you looking to buy, sell, invest, trade up, trade down? What's the situation? Right? Then because then I mean, if you're looking to sell, I'm like, hey, you're still getting great prices for your home. It's just sitting on the market for a lot longer, right? And a lot longer basically means from 3 days to 30 days, which by the way is a normal market. We just say a
Yeah.
lot longer because it's all relative, right? Um,
It
right? Or
is.
if they're looking to buy, like the differences between that. So you're absolutely right. It's just guiding you through these roads, because if you have somebody who has a lot of experience, you can, like, your financial health is so important, especially these days, that you can just, you know, essentially get the playbook on the direction to go and the best way to save your money. There's a lot of these articles that you see out on CNBC about your personal finances in today's market and how to guard against inflation and whatnot. We're there on the front lines, Ed, right? You and I.
I mean, we live
Provide
this
that.
24/7.
Yeah.
Yeah, this isn't a hobby.
Mm. Well,
We're
that
not
being said,
hobbyists.
yeah, I just want to say, I know that we've both been tied up for the
Yeah,
past few weeks,
yeah.
and I'm excited to go to Video Summit in LA next week.
I'm
Just
excited for you, and I can't wait to hear what you got to say when you come back.
we're gonna have a great episode once I come back, and
I
what
love it.
they talk about. I mean, just for our own thing, and we're trying to do with educating the public and how we can
Yeah,
optimize that. But from there, I go straight to Housing Wire in Phoenix, and I'm going to see our boy Logan Motoshami. I'm going to
nice.
see the CEO, the skipper of my company, Gino Blafari, who started Intero Real Estate, and then which got acquired by Berkshire Hathaway. Now he's
Yep.
CEO of Home Service of America. My coach Tom Ferry is going to be there, so they're
Wow.
calling this the. I'm so sorry, folks, for this, but the Davos of real estate. I don't mean to sound so smug with that. I've never been to either. This is going to be my first one, but I'm pretty excited to get
I'm
down
excited for you, man. Make sure you take pictures with Logan. I
all
want
these
to see that,
industry
man.
standards, all these industry standard guys just picking their brain about what's going on with the
Oh,
market so we can come back
priceless.
and chat. And Ed, he's also a fellow 49ers fan. Debo Samuel is his favorite player, even though he's
Oh,
away.
okay.
So
All
shout
right.
outs to my man for repping the
Nice.
Niners all the time.
Nice. Yes, shout out to him.
Yeah.
Very good, man.
I appreciate you taking the time to be here with me, Ed. It's great to
Always
chat with
fun.
you as always.
All right, guys. Well, you heard it here first. Here we are. You need anything, you have questions outside of these topics, you want some advice? We're the Batman and Robin of real estate. He's
That's
Batman, I'm
right.
Robin. Here we go.
And we're gonna have the show notes for this episode, and our information is at the bottom. So if anyone wants to
Excellent.
connect, and you can reach out to me, and we're
Right
always
on.
here for you folks. I appreciate your time again, Ed. Thank you so
Yeah,
much. I know
thank
you're
you.
a busy man.
Thank you as well, man. You have a great day.
All right, you
Be
too.
well.
Take it easy. Bye now.